Hey guys, welcome back to the channel. This is Future Trading with Mike. Today is Saturday morning, almost noon time, but it is 11:30 my time, Eastern, and I want to cover a topic to kind of clear the air a little bit, maybe kind of clear up some misconfusion, because some people see me trade straight off a 12 range or 4 range. That doesn't mean I'm taking my trades solely off the 12 range, and that's it. I'm not, meaning that I'm not looking at another chart. I have to have a supporting chart from whatever time frame I say I'm trading off of to see when price pull back to a certain area to see if it's going to, do its thing, meaning showing me rejection at that particular area that I may mark off on my 12 range chart. So when I say I'm trading off my 12 range chart, that is me saying that I'm marking a zone off my 12 range chart, and then I'm using a supporting chart, which is my lower time frame, my lowest time frame chart, my 4 range chart, to see if I'm going to get some rejection when price pulls back to that zone. So the question at hand, the topic at hand in this video here is more centered around how to trade with the confluence of using the higher time frame and why you should do so. So let's say that again. How to trade with confluence from the higher time frame and why you should do so. Those are two important topics or things that you must grasp to be able to understand the correct way of how I trade, in a sense. Okay, now you trade how you want to. You don't have to follow my strategy. This is how I trade, and I'm not telling you, and nor have I ever said to trade the way I do. This is my strategy of how I actually trade. So whatever works for you, and stick with that. Okay. Some people have commented and sent me messages saying, "I like your style of trading." I kind of, they say I take some of what you're showing and I incorporate it into my style of trading. So which means they have their own strategy of how they trade, and they're taking little tidbits and adding it into to their trading style or incorporating that in. And I do the same thing. When I first started off, that's the one thing I was trying to do was, and it's still to this day, it's like, I see other people trading and I say, oh, okay, I kind of, look at the style of how they actually trade and maybe kind of see how, I could maybe blend it a little bit into the style of the way I trade. Or I'm always reading and looking at, videos from online, always doing research is what I'm trying to say, to see how things could probably, make my trading a little better, whatever the case is. One thing I'm working on personally is trying to stay my trades longer, but that, like I said, that all has to do with price action, price movement at that time, no matter, depending on what time frame I'm looking at, whatever the case is. Because smaller or lower time frame charts, you may not have much area to actually trade from, so you're doing a quick little scalp, whatever it is. But across the board as traders, we're always learning and trying to gain a better edge of how we can improve our own strategy, whatever the case is. But I like trading supply and demand areas. I'm not a break and retest type person, but sometimes you do get break and retest that where the move may be great and you say, oh man, I missed that trade entry, whatever the case is. So every once in a while I may take a break and retest trade, and all that is price, as price is making higher highs and higher lows, say for example, and price pulls back, it pushes up, pulls back, breaks through an area of resistance, and then pulls right back to that area of resistance. That's called a break and retest. And the same thing when prices move to the downside, making lower lows and lower highs, it pulls back to, it's breaking through support and pull right back to it, testing support again, and then you're looking maybe for an entry if you see the rejection. So let's talk about why or how to trade with the confluence or using the confluence of a higher time frame and making sure that you're trading in the same direction as the higher time frame and why you should do so. It's important, okay? And I'm going to cover an area, kind of the same area I talked about yesterday, which is the same area I talked about yesterday in one example and what I was showing at the beginning of yesterday's video. All right, so let's take a look at 12 range chart. Okay, I know I say we always take a look at the higher time frame, but I just want to show you this area right quick. This was from yesterday's trading video. Okay, this area right here. All right, this area right here where price pulled back to this area right here. Say for instance right here, I think it was around 11 o'clock, whatever the case is. 11 o'clock in this area right here. All right, so I got this drawn out with a rectangle area. Okay, a rectangle box here. Okay, now here's the thing. Start off with the higher time frame. I marked that area because I'm looking at my higher time frame to start with, right? Always gauge and use your higher time frame to see if price, I say this over and over and over again, if price is in the area of supply and demand, okay? we see here where price, okay, back on June 30th, say for instance right here, price pushes up, pulls back, okay, and then it moves higher, okay? So price is forming structure to the upside, right? And it's breaking structure. Oops, didn't mean to do that with a rectangle. So, and as it's pushing higher, what is it doing? It's breaking structure to the left-hand side where price moves to the downside. Makes a high, pulls back, breaks higher, right? Now, as price pulls back, what do we look to do? See here. This area here is a pretty much a zone, okay? But this area here, let me say this correctly. Price broke up, pulled back, okay? Broke this area here, formed a lower high, a higher low to make a higher high here, right? So when it pulls back here, what do we have down here? We have a zone that we can mark as a key area of what demand, okay? So I'm going to draw this area here as kind of the key area of demand here from pretty much the top end of that red candle there down to the lowest wick of the move to the downside, okay? So all this is kind of the area, the zone, whatever the case is. Price taps into it, okay? We see price tapping into it, right? So this is the demand zone. It is a big zone off of the 60 range chart, but this is an area of demand where price is breaking structure to the upside. A big break to the upside, okay? Now, I'm not trading off the 60 range chart, but all I'm doing now is that once price has made this structure to the upside, meaning it's making higher highs, makes a higher high, higher low, and a higher high, it's breaking resistance, breaking through resistance to the upside. I mark the area where aggressive buying took place at, okay? All right? So all I'm doing at that point now is waiting for price to pull back to the area of demand. Say, for instance, where the zone I have marked off, right? Now, the thing now is you must, once price gets back, it pulls back to this area right here, meaning it starts selling off on a pullback, okay, to this area. Once we tap into it, I then scale down to a lower time frame chart. You have to be able to understand, wherever you're marking, whatever chart you're marking your zone off of, you don't take that trade off that same chart. Meaning, I'm not taking my trade once price gets back to that zone of the 60 range chart to start looking for maybe opportunities to go long. I'm going to scale down, okay? Because then I want to start seeing if price is going to start, making structure or breaking structure to the upside, and then I'm looking for the pullback off my lower time frame chart. So my anchor chart I use, which is my lower time frame, from my, say for instance, my 60 range, I'm gonna start looking at my 12 range. Okay, all right. So price is back in that zone. So now I'm looking at my 12 range chart. So I believe this high right here is 78. Is that same high, right? Oh, excuse me, no, it's not. I'm sorry. This high that price made right here at 50, say for instance, is the same high if we look at the 12 range, right up here. Sorry about that. Right up here. That's the high. This is that pullback, okay? All right, price is pulling back. So if I was to, price is pulling back, okay? As price pulls back, it taps into, we see it on the 60 range. Once price pulls back to this area here, now what are we waiting to see? We're waiting to see if price is going to start rejecting, meaning making structure to the upside, off the 12 range, okay? So price pulls all the way down to the area we can see, okay? All right? Okay, so price, this is the area right here. If you're looking at the 60 range chart, you'll see that price is tapping into that zone. And all it's doing on this moving to the downside is making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, all the way down. When it gets into that zone, it really starts getting into the zone up here. But if you follow price action, you'll see that you're not getting any good structure breaks back to the upside where you can take a trade on the pullback to a zone. Okay, so down here is where it actually happens at, inside that zone. It's still inside that zone. We're looking at the lower time frame chart from scale down approach from the 60 range, okay? We're in the zone off the 60 range. Now I'm looking at my 12 range chart, okay? Looking at my 12 range chart. So now that we're in the zone, price, kind of does a reverse here. It does a reverse, starts pushing to the upside, making higher highs and higher lows, okay? I'll move to the upside, okay? Moves up, pulls back, breaks higher, pulls back, breaks higher, okay? So it's making those structure breaks, meaning it's taking out and breaking through structure as it's moving to the upside, okay? Now, here's the key. The key is taking a look and making sure, like, where price came down and tapped into that zone off the higher time frame. Then we start to see price breaking structure to the upside, making these higher highs and higher lows, taking out, push up, pull back, breaking through resistance on the move to the upside, okay? Now, the thing about it is that I want to take my trade on a pullback to where, say for instance, the move originally started happening. So this is one leg to the upside here. I mentioned this yesterday. Try not to take the trades from the midpoint or 50 percentile area of a mid portion of a leg to the upside, say for instance, or same thing in price moves to the downside. But because you want to get in more so to the trade where the buying was actually kind of started happening at, I say this many times again, where, you know, the aggressive buying, the buying started taking place. A lot of buying came out of this area right here. Why? A lot of green candles to the upside, right? And this is the area where the rejection started taking place at, right here, okay? Rejection where the area started taking, where the rejection started taking place at originally, okay? Meaning once price pushed up and broke through structure over here and started breaking structure to the upside, meaning pushing up, making it high, taking out resistance on the way to the upside, okay? This was the area where it all started at, okay? This was the origination point. So I know, you know, if I'm looking at something, you gotta ask yourself, what's high probability, what's low probability? This, when price comes back to this area, because this was where it all started at, is going to be more of a high probability area than more so taking a trade right here, because, and two, this is at the more so the 50% area of where, even though price pushed up here, pulled back, and then broke higher for another swing to the upside, it pulls back here. We're 50% within this leg right here, within the 50% area of this leg. So, you know, to me, not saying that price can't reject this area when it gets back here. It's all based upon what's going to happen price action wise once price gets back to this area. Okay, so this makes more sense for me from a high probability standpoint than this area here, because the 50% area, say for instance. Okay, I'm not saying price can't pull back, okay, within structure here, because yes, there was some buying that came out of this area, but you must also understand too that not every trade is going to work out based upon a certain strategy. Even though you got a strategy, it may work out 90% of the time, whatever the case is, but there's bigger players in the market that may not want to see price pull back to this area right here and, you know, for it to push up higher here. They want to probably pull the market back down here where there's more high probability chance of the market pushing higher, because this is where everything started at. You know, when price started rejecting, okay? Started rejecting, meaning out here somewhere it was hitting some area of support, which we are in an area of demand off the higher time frame chart. So that's why I say be in Confluence and taking trades with the higher time frame chart, which is the 60 range, because we're in an area of demand, and allowing price to pull back to an area. Always looking for the origination, more so the initial area where price started rejecting as it started breaking structure to the upside. Okay, what was there? Where did it start happening at? Right here in this area right here. It made its first swing up here, pulled back, it broke structure up here. So, the moment I see price break through this structure right here and start making you know, small little higher highs and higher lows to the upside, breaking through structure and breaking structure, meaning it's breaking resistance on the move to the upside, I know that this is going to be more so a key area once price gets back down to it, a key area for a bigger move, a bigger push to back to the upside, which would be to this high area, this area right here. If I try to, you know, if once price starts pushing higher, pulling back and then breaking higher, still breaking through breaking structure, meaning breaking through areas of resistance and taking out areas over here. I'm not saying that price can't pull back to this area right here and there could be some rejection, but you got to think low and high probability trading. Okay, this is 50% of a leg. Okay, all right, and the move. Where did the buying start at? Where did, you know, everything originate? Back down here at the bottom of this leg right here. This is where, you know, the buyers really started stepping in right here. Boom. They started stepping in hard, pushing the market up, aggressive, all this buying right here. Pulls back, more buying came out of this area here. But I'd rather be on the move where it started at than being halfway on the, being into, or trying to get back into the move halfway, you know, halfway into the move. Meaning, basically, this leg to the upside, this is the halfway point here where aggressive buying took place. Some more buying took place. It pulls back right here. Is there a chance that it could, you know, reject and push higher? Yes, it can. It really can. But the thing about it is that it's like you want to think about getting into the trade where it started at. Okay, once it pulls back, I'd rather be in more of a high probability position, knowing that when price pulls back here, because this is where everything started at, where they're buying accumulated at. I want to get into the trade here, not here at the 50%. Okay, I want to get back in here, ground zero, where it started at, and started building the foundation back to the upside, providing you for a better position to be in, and then taking that trade going back up. So, it all started here. This is where the foundation started at for the big, for all the aggressive buying took place at. It pushes up here. Yes, more buying came out of this area, like I said, but this is kind of, the halfway point of this leg to the upside here, as price was swinging to the upside here. Then it pulls back. This, to me, is where I'm looking at for more of a high probability trade. So, I guess kind of look at standpoint, if you're looking within a leg here, within a leg, and then you got a 50% area here where price would trace back to, where there's a swing to the upside. To me, that would be more so of a lower chance or lower probability of trying to get into a trade. Now, would I take, taking this trade right here, I'm going to kind of like, in my mind, not pay close attention to these areas, because I know this is not where the buying started at when price started rejecting off an area of demand off the higher time frame or a major area of support. Okay, I know that's not where it started at, because it all started right here. So when I see this leg that's pushed to the upside, I'm immediately looking back down and seeing, oh, it all started right here, not right here. Yes, some more buying came out of this area. Could you take this position here when price pulled back? Yes, but I need to see if price pulls back to this area right here. I need to see, for price to show me even more rejection. So that's when I start looking at my 4 range chart. So my thing is, price pulls back right here, even though it closes green right here. Am I going to go take a trade right off of 12 range to the upside? No. The higher probability is right here. I feel more comfortable trading off directly off the 12 range if price comes back to this area, because I know it all started right here. Right here is the midpoint of this leg right here. So it's the 50% area. Price comes back to it. More likely, I'm not going to take a trade right off of this area, right at this area right here, the moment this candle closes green to the upside. I want to start at that point, start seeing if I even have greater confluence with even a lower time frame chart, okay, which is the 4 range. So we'll switch over and take a look at the 4 range now. After looking here, blow this back up on the 12 range, if I can get it back up right here. All right, so we'll take let's take a look at the same area on the 4 range I just mentioned. Now I want to see, all right, it's at a halfway point here, 50% area of this leg. It's pulling back to this area. Was this an area where things kind of started at? No, it's not. It's back down here at the lower portion. This is where things really started taking off right here, where the buying really started accumulating more and more to the upside. Okay, came back here. That's halfway of the move. All right, it's halfway into the move. Take it back down to the lower portion, higher probability area. Right here, I consider this more of a lower chance. Let's look at the 4 range. We're going to scale down now. Now that we pull back to this area right here, okay, right here around 3760, look at the 4 range and see if that's going to tell us anything. Give us even a greater sense of confluence to maybe want to take a trade going long. All right, it gets back into this area right here. It's the zone, that box, that zone I showed you at that 50% area off the 12 range chart. Now we're down to the 4 range chart. Now that we're down to the 4 range chart right here, here it is right here. All right, what are we looking for? The same thing to happen. We want to see if there's going to be structure breaks to the upside. All right, what does price do? Pushes down here, pulls back. I don't really get a close of a red candle to the downside, so to me this is not really like a lower low. It pushed down. It pushed down here, pull back, push lower, wicken out, just to pull back higher, right? Okay, so to me, the actual structure break is going to mean that I got to see price take out a complete level to the upside. The level was price made this move to the downside, pull down, pull back, made a low, pull back. To me, this is not really considered a full low, even though it did come down and push through a little bit to the downside. I didn't see a solid red candle close to the downside here. Turn back around, wicked out with a green candle. So this to me is not considered a full lower low until I see that imprint of either a red candle to the downside or closing, or a red candle wicking down to the downside. So that's all about learning candlesticks as well, guys. So to me, when I see this right here, I really want to see price at this point here break up, meaning all it kind of did was when it pushed down here, made a low, pull back, and it made a lower low here. Okay, so what I want to see price do is really take out this area here and get a pullback. It didn't do that. It didn't do that. So what I'm talking about is seeing price. This is what price did. Pull down, pull back, breaks into the zone now. Okay, makes a lower low. I need to see price maybe push up, pull back, and then do something like this to look for a long entry at the zone right here, in this area right here when price pulls back. Okay, it doesn't do that. What does it do? It keeps pushing to the downside. All right, so to me, that's even, that right there in a sense even tells me even furthermore, and looking at the full range, and that's why it's imperative to look at all time frame charts. I say that time and time again, even though sometimes I say, even on Discord or in my videos, I say I take a trade off the 12 range chart, I take a trade off the 4 range chart, whatever the case is. But that's not without taking a look at to see what was going on in the higher time frame. We want to be trading in the same direction, and trading in the same direction as the higher time frame. And then we will mark our zones. We want to be trading with Confluence. So if we have a higher time frame, the 60 range chart, scale down to the 12 range chart, price pulls back, onto the 12 range chart, like I said, into that 60 range zone, I'm going to be more comfortable because I just showed you that of going long. But it's like I said earlier. We hit the zone here. Price pulled back here. I scale down to my 12 range chart at that time. Are we in that zone? Yes. All right. Do I see structure? We're in the zone. Do I see structure breaks? Yes. All right. I'm going to move to the upside. It broke through structure, and it started making those little higher highs and higher lows, with a followed up by a bigger swing to the upside, making a high here, a lower high. A higher low, and then a higher high here. I just mentioned 50% of the area is more of a lower probability chance to me. I want to see get into the move down here when it pulls back to where things started at, okay? Once it breaks structure, okay? All right, once I see it break through structure, it's got to break an area here first. Once it starts rejecting, it breaks it. It breaks here, and then starts breaking through resistance as it makes higher highs. Excuse me, guys, higher highs and higher lows to the upside. This is the area right here, all right? So when price, again, pulls back to this area right here, I'm reiterating this again and stating this again. If it pulls back to something like this, a low probability area, to where, yes, probably price could possibly reject it because, yes, we do have continuation to the upside and it pulls back, I'm going to look even further dig deeper and start looking at my 4 range chart, and that's what I do. Go to the 4 range chart, blow it up. This is the area right here. Price pulls back to the area. I don't see where it's breaking any structure back to the upside. Okay? I just showed you. If it did then pull back to this area, I'm being interested in going long. Just back up to, give you an example. I'll show you. I just did. It made a low here, pulled back, made a lower low. I need to see it make a move like this to the upside. Okay? All right? And then once it does that, it comes back here. I look for, once price rejects, okay? So then I mark my zone off the 4 range then, okay? Mark my zone off the 4 range. Once it rejects this area, I can take it back up to the high right here, okay? So you have to be looking at multiple time frames to get multiple areas of confluence before taking a trade, and there's what's called, like I just said, high probability and low probability zones, okay? And that zone at a 50th percentile area to me is going to be a low probability zone, okay? Now then I got a question about this area right here, say for instance, okay? Right here, we're moving on now. The price pushed up here, pulled back, and then it eventually broke higher, okay? So it made another swing to the upside at the pulling back, okay? All right, breaks higher. High, higher low, meaning it didn't break this low here. This is the low, okay? All right, as it's continuing making the move to the upside. High, okay, pulls back, okay, to break structure to the upside, making another high here, all right? So as price is continuing to break to the upside, it pulls back. Yes, we have swings within this swing here, this swing to the upside, okay? All right? So these swings are within this bigger swing to the upside. This is what I consider supporting swings on this move to the upside, okay? As price made this high right here, okay? Yes, anywhere price can pull back to one of these areas, one of these supporting swings, okay? And it could be an area where there could be a zone edge you could draw, say for instance on a 12 range chart, but you just can't trade it right off the 12 range chart, okay? If you're looking, say for instance, this area right here, Okay, this area, price pushed up here, pull back, made a high here, pull back, made a high. So this area right here, if this is 1, this is 2, we can just mark the zone right here. Okay, we do that. Okay, price pulls back to it. Okay, supporting swings out of this bigger swing to the upside. Pulls back because we are continuing to make moves to the upside, meaning we will continue swinging up to the upside, making higher highs and higher lows, breaking through areas of resistance. Sorry, should have drew that a little straighter. Resistance here, resistance here. It's breaking through them. Pulls back. Okay? All right. So here's the thing now. If you're setting zones up or marking zones on your 12 range chart, do not trade right off of that the moment it comes right back to it on your 12 range chart. You have to, at this point here, again, look for scale down to a lower time frame chart to see if you're going to get that rejection. This is using the higher time frame chart in Confluence, okay, with as you scale down to your lower time frame chart, okay. So price pulls back to this area now. Now you've marked a zone off a 12 range chart. You no longer look at your 60 range chart. You're referencing your 12 range chart now, okay. So once price moves back to say this area right here, what are you going to do then? Okay, what are you going to do then? Let's draw it out right here, okay? Because price comes back to the zone. Now we're hitting into the zone off of, which could be demand zone off the 12 range chart. All right. So now we're going over to our 4 range chart. Let's see, what was this at? So I can kind of reference it. 12, 1 o'clock, around the 37.68 area. Okay, so let's see. Squeeze this in, guys, so you can see. Okay, so here it is right here. This is the zone. This would be the zone. Same zone you've seen on the 12 range chart. This area right here. Okay, just for a quick example right here. All right. All right. Does price come back to that area? Yes, it eventually comes back to that area right here. Okay. Now, what the same thing I was just showing as an example using the 60 range, scaling down to the 12 range. Now you've drawn a zone off the 12 range, and now you're scaling down to the 4 range, waiting for the rejection. Price has come back to that zone. Okay, it's hit it. Okay, all right. So what do we need to start happening now? Now that we tapped into the zone, what do we want to see? Like I just said, we want to see structure breaks back to the upside. We want to see if price is going to reject and hold to the zone. Okay, meaning see if it's going to start making those higher highs and higher lows to the upside. Meaning it makes a high, breaks back, makes a higher high, breaking through resistance here, taking out structure over here. All right, I'll paint it again. Pushes up, pulls back to break higher, taking out resistance, taking out structure, so that's breaking structure. All right, and where did the move start at? At this point here, we see the move. This is where the buying took place at. This is where the rejection took place originally. This is where the buying and aggressive buying took place at. So what do we want to see? Price to come back to that area. Some people will say, well, the same thing as you see an example again. Price come back to this area. Oh, will I go long here? No, because to me, here's the leg to the upside. You're taking a leg at the 50% area again here. I want to get into the trade where it happened at, where there's greater or higher probability at, where the origination of all the buying started in the move to the upside, to the incline, to the upside, okay, which was down here. So I marked the zone. Now I'm marking the zone that I'm just waiting for off my 12 range. I mean, excuse me, my 4 range. Boom. Okay. All right. Pushes up, pulls back, breaks to the upside. You got a leg to the upside here. This would be like the 50% area. Price comes back to it. Would I trade this? No, because it's lower probability. I want to see it when the price. I want to get to the move where it started at, where all the buying took place at, right here, off the rejection of the 12 range demand area that we drew up off the 12 range chart. Now at the 12 range, we're using more so as our higher time frame chart and referencing the 4 range as our lower time frame chart, waiting for rejection. So as it comes back to this area here, once I see this, I am long. Once the candle or 2 breaks above, I long, take it back to the upside here. You get into a long, say 37.70, 37.71, or whatever the case is, take it on back up to 37.76. And that's one thing that I'm working on to kind of enhance my trading to better myself when it comes to trading. But that's how I scalp each and every day. Sometimes, lots of times, I get out way sooner than that, depending, because sometimes, I get a little iffy when it comes to seeing the market kind of pull back. I say, oh, it's coming back against me. I get out. So that's a lot of times how I safeguard myself, is like I go ahead and take a few ticks and get out, because if it starts pulling back too heavy, I kind of get scared and I just go ahead and get out, because I don't want to start taking a loss, whatever the case is. So that's why I'm able to build up on, 7 to 8 ticks each time, or whatever the case is, and then I end up with 40, 50 ticks for the day or more, or whatever the case is. Sometimes just 30, but it just depends. But this is what I want to show you guys. You have to always trade and be in confluence with the higher time frame when you're scaling down and looking for rejections off the lower time frame chart. You have to be in confluence, and this is why you should. Because if you're not in confluence with what's going on the higher time frame, then what you're going to end up doing is you're going to take a loss. Okay? Because you're not moving and waiting for price to pull back to an area where a move started at. Okay, you may be trading halfway through that move, price comes back to it. If it does, I got to start seeing, I got to be able to see something that's going to give me more a supporting factor, something that's going to be, kind of hold strong too, meaning that it's got to be able to give me more evidence that price wants to continue moving in that area. So if I take a trade on a 50% retracement, or whatever the case is, I'm not using Fibonacci, but I'm just saying 50% into a leg, I got to say, okay, we're back to this area here. Yes, price is continuing breaking higher, making higher highs and higher lows, breaking through resistance. It's back to the 50% area of a leg. Let me scale down and see if price is going to even show me further rejection, or give me more evidence that it wants to continue pushing higher. So that's how I trade. That's how you reference a higher time frame and start scaling down. You use it as a guide. Okay, so that's pretty much all I have today, guys. I just wanted to kind of wrap that up in a video and go more into depth about using the higher time frame as confluence when referencing that higher time frame, scaling down to your lower time frames, and looking for once price pull back to those zones. Reference that higher time frame, guys. You got to be able to use means of confluency when you're trading. You just can't trade off of one particular. Say I'm trading straight off the 12 range chart or the 4 range chart. I say that when I'm saying that in Discord, I'm not saying I'm just waiting for price to get back to something, a zone marked right off the 12 range chart, and taking it right off the 12 range chart. No, I'm not. So when you see me take a trade right off the 12 range chart, what I've done is I've marked up a single price was hitting an area of demand or supply on the 60 range chart. Prices come back to that area on the 60 range chart. I noticed, looking down at the 12 range chart, where price is broken through structure and started making structure breaks, and then pull back to the zone that I marked on the 12 range chart, and then boom, once it gets to that area, price closes green to the upside. If it's in an area of demand, I'm going long. If it's an area of support, once it closes red to the downside, off a zone drawn off the the 12 range chart, but it was hitting an area of confluency off the higher time frame chart. If it's an area of supply, once I see that structure being broken to the downside at an area of supply, pull back, red candle close, I'm short. So you have to be able to use multiple time frames. Confluence is all I'm trying to say, guys. Okay, so hopefully that covers that topic. I know it will take practice, and you have to give it practice and practice and practice and practice it more and more and more. A lot of times in my videos, I don't have other. I'm zooming in, looking at the 12 range chart. I'm zooming in, looking at the 4 range chart. Whatever the case is, I say I take a trade off the 4 range chart, but that's because I took a trade off the 4 range chart because I noticed a demand and supply zone off the 12 range chart. Okay, at that point, if I'm trading off the 4 range, I'm interested in something that happened on the 12 range chart, and then price. Then I start looking at my 4 range chart in detail, and I start to see structure breaks. And once I start to see structure breaks and I pull back to that zone that I marked, at that point now, off the 4 range chart, I'm long or short, just depending. Okay? So I'm going to wrap that up. I hope that makes sense to you guys. I don't know any other way to kind of more in depth go into detail about that other than, you practice it yourself. But all what I'm trying to say to you, and I will say it again, use your higher time frame. Mark your zones off your higher time frame and reference that chart, the higher time frame chart, and be in confluence with that, trading in the same direction as the higher time frame. Mark your zones from it. Scale down to your lower time frame. Okay? Wait for the breaks in structure. Okay? Once it does that, and it's hitting off, let's say, an example, an area of demand off the higher time frame, 60 range. 12 range starts to break structure. Wait for then once it starts breaking structure, mark your zone on your 12 range there. Wait for price to come back to it, and then take your trade. But make sure you are trading in Confluence with the higher time frame. Okay? All right, guys. I'll see you on Monday morning in the next live recorded session, and take care. Have a great weekend.